Welcome to The Explainer. Today, we're putting on our financial analyst hats to conduct a strict, by-the-numbers autopsy on a true legacy retail icon. We're going to look right past the empty storefronts and the nostalgic headlines to figure out the exact financial mechanics that dismantled Toys R Us. To really ground our analysis today, I want you to hold this staggering figure in your head, $11.2 billion. At its peak, that's the annual revenue Toys R Us was generating. We aren't analyzing some fragile tech startup burning through venture capital here. This was a financially massive, well-established asset. So it begs the ultimate analytical question. How exactly does an $11 billion empire just go bankrupt? Now, the mainstream narrative loves to say that kids just stopped playing with traditional toys, or maybe management just couldn't figure out the internet. But as we unpack the balance sheets, you'll see this collapse was fundamentally a structural failure of capital, not some sudden drop in consumer demand. Here's our roadmap for today. 1. The healthy asset. 2. Anatomy of the buyout. 3. The debt service trap. 4. Competing with handcuffs on. And 5. Autopsy of a liquidation. Let's jump right into part 1, the healthy asset, where we'll establish our baseline metrics. If we look at the baseline health of this company before 2005, it's absolutely crucial to realize we're not dealing with a distressed asset. Toys R Us had 1,600 retail locations worldwide, churning out that $11.2 billion in annual revenue. They had incredibly consistent profitability. And, arguably most importantly, they had already survived fierce price wars with major discount retailers like Walmart and Target. But here's the catch. Because they were a publicly traded company with incredibly stable, predictable cash flows, they became a wildly attractive, prime target for private equity firms looking for a leveraged buyout. Moving on to part 2, anatomy of the buyout. Let's look at the financial engineering event itself. To really grasp what went down in 2005, we have to define the leveraged buyout, or LBO. Objectively speaking, this is just a standard capital restructuring tool utilized by Wall Street. It's simply the acquisition of another company using a significant amount of borrowed money to meet the cost of that acquisition. And the wildest part, the assets of the company being acquired are often used as collateral for those very loans. Think of an LBO kind of like buying a house. Imagine you want to buy a $500,000 house, but you only put down $50,000. You borrow the remaining $450,000. But here is where corporate finance totally diverges from personal finance. Instead of putting the mortgage in your name, you put the debt in the house's name. You own the house, but the house itself is legally responsible for paying back the loan you used to buy it. So let's apply that exact same math to the 2005 capital restructuring of Toys R Us. 3 private equity firms, Bain Capital, KKR, and Vornado, teamed up for a $6.6 billion acquisition. They put down $1.3 billion in their own equity and borrowed the remaining $5.3 billion. But crucially, that $5.3 billion in newly leveraged debt was placed directly onto the balance sheet of Toys R Us. Practically overnight, an operationally healthy company woke up owing over $5 billion it never actually chose to borrow for its own growth. That brings us to part 3. The debt service trap and the resulting cash flow squeeze. The real antagonist in our financial data today is this exact number, $400 million. Because that $5.3 billion in new debt, it absolutely wasn't free. Toys R Us was now required to pay roughly $400 million every single year just in interest payments to service that newly acquired debt. That $400 million debt service literally choked the company's free cash flow. In analyst terms, it severely suppressed their capital expenditures, or CapEx. Every single dollar going to Wall Street to pay interest was a dollar that couldn't be spent on modernizing aging stores, building out a competitive e-commerce platform, training employees, or actually enhancing the in-store customer experience. The business was just systematically starved of the fundamental reinvestment necessary to survive in modern retail. And the cash drain didn't even stop at interest payments. Between 2005 and 2017, the acquiring private equity firms extracted an additional $470 million from Toys R Us in the form of management and consulting fees. So the company was suffocating under this massive loan used to purchase it, while simultaneously paying out hundreds of millions in fees to the very firms that orchestrated the buyout in the first place. Which leads us to part 4, competing with handcuffs on. We're looking at a massive competitive deficit here. This timeline perfectly isolates what we call the innovation gap. Check out the timing here. 2005 is the exact same year Toys R Us undergoes its leveraged buyout. And it happens to be the exact same year Amazon Prime launches. Over the next 12 years, from 2005 to 2017, while Amazon is aggressively scaling its physical logistics and digital footprint, Toys R Us is forced to funnel its cash straight into debt servicing. By 2017, foot traffic at physical stores naturally starts to decline, but Toys R Us has absolutely no robust online presence to offset those losses. This wasn't a lack of foresight by management, guys. They were physically unable to fund innovation. Just notice the stark contrast in capital allocation between these two. While Toys R Us was forcing $400 million a year just into debt interest, Amazon was dropping $13 billion into warehouses and prime infrastructure. Toys R Us was stuck with a stagnant legacy website, while Amazon was pioneering one-click ordering and same-day delivery. This structural economics mismatch created an insurmountable competitive deficit. You simply cannot win a retail war when your opponent is investing billions into the future and you're trapped paying billions for the past.
Finally, we arrive at Part 5, Analysis of a Liquidation. Let's look at the final balance sheet.
Those financial handcuffs eventually worked exactly as the math dictated they would. In September 2017, Toys R Us filed for Chapter 11 bankruptcy. By March 2018, total liquidation was announced and 33,000 employees lost their jobs. Now, from a strict financial analysis standpoint, what is most notable here is the asymmetrical risk. The acquiring firms, Bain, KKR, and Vornado, were largely isolated from the final collapse. Because they had already extracted hundreds of millions in management fees and dividends over the previous decade, they essentially walked away intact. Meanwhile, the company itself, its employees, and its vendors absorbed the absolute entirety of the fatal blow. We're going to wrap up this explainer with a key takeaway that every analyst needs to remember. Bad debt structure can kill a healthy company faster than bad products ever will. Toys R Us didn't die because an $11 billion market for toys just vanished into thin air. They were structurally dismantled by a balance sheet that prioritized debt service over adaptation. So as you look at the modern corporate landscape today, it really begs the question, when a legacy brand falls, are you actually watching a failure of the free market, or are you just watching the highly predictable results of financial engineering? Thank you so much for joining me for this analysis, and I'll catch you in the next explainer.